What happens when a dentist bills your insurance for services you never received and then threatens to send you to collections? In this real-life personal finance story, a patient trusted their longtime dentist only to discover their insurance was billed $2,000 for orthodontic services that never happened. The insurance company investigated, confirmed insurance fraud, and clawed the money back. But instead of backing off, the dentist's office turned around and threatened the patient with collections and credit damage. This video breaks down dental insurance fraud explained in plain English, what an insurance clawback really means, whether a patient is responsible for fraudulent medical billing, how collections and credit reporting work in medical debt cases, what to do if a dentist threatens collections after insurance fraud. If you're worried about your credit, medical, or dental debt, or dealing with a shady provider, this story is a must-watch. Comment: have you ever dealt with medical billing fraud or collections threats? What would you do in this situation? Share your thoughts below. Second Reddit story: using a credit card instead of a debit card. One random bank teller said one sentence, and it could literally change someone's financial future. Not an advisor, not a millionaire, a bank teller. Story start. So here's what happened. I'm at the bank, just doing normal stuff, checking account, debit card, nothing fancy. Then the teller looks at my transactions and goes, "Hey, I see a lot of grocery and gas charges." I'm thinking, okay, that's called surviving. But then she says something unexpected. She tells me, you should use a credit card instead of your debit card and just pay it off before the end of the month. That stopped me, because in my head, credit cards equals debt, debt equals stress, stress equals bad decisions. So now I'm standing there wondering, was she actually helping me or setting me up for trouble? The real question. Let's break this down. I have a high-interest credit card, $5,000 limit, not a fancy rewards card, not 0% APR, the kind that can hurt if you mess up. But here's the twist. I wouldn't be spending more, just moving my gas and grocery spending from debit to credit. Same money, same budget, just a different card. And the plan? Pay the full balance before the month ends, every single time. Sounds simple, but emotionally, it's scary. Because the second you swipe credit, it feels like you're borrowing, even if the cash is sitting in your bank account. There's this quiet anxiety. What if I slip? What if one month I can't pay at all? What if this turns into a balance, and then interest, and then a cycle? That's how people fall in, not with big shopping sprees, but with normal life expenses. But here's why the teller might actually be right. When you use a credit card responsibly, three big things happen. Number one, you build payment history. Every on-time payment says to lenders, hey, this person is reliable. That's huge for your credit score. Number two, you show active credit use. If your card just sits there unused, it doesn't help much. Using it for normal stuff shows you can handle credit like an adult. Number three, you control utilization. This one's important. If you keep your balance low compared to that $5,000 limit, like under 30%, your score likes that. So groceries and gas, that's actually perfect spending. Predictable, necessary, already in the budget. You're not borrowing to impress anyone. You're just rerouting money. But here's the danger. This only works if one rule is never broken. You do not carry a balance. Because that high interest part, that's the trap waiting quietly in the background. Miss 1 month, pay only the minimum. Suddenly, groceries from 3 months ago are still following you with interest. That's when helpful turns harmful. So emotionally, this strategy needs discipline, not motivation, discipline. You have to treat the credit card like a debit card with extra steps. Swipe, go home, money already set aside, bill comes, paid in full. No exceptions. No, I'll cover it next month. What's crazy is this didn't come from a finance guru, just someone who sees people's accounts all day. She probably sees two types of people, the ones drowning in credit card debt and the ones quietly building strong credit using the system correctly. Same tool, very different outcomes. So now I'm curious, was this simple advice actually a smart credit building move or the first step towards a slippery slope? Would you switch gas and groceries to a credit card if you knew you could pay it off every month? Or do you think debit is safer no matter what? Drop your take below because I really want to see where people stand on this. Third Reddit story. It feels like I'm seriously behind on saving for retirement, but is it really as bad as it seems? He's 41 years old, makes $130,000 a year, does everything right, and still goes to bed thinking, I'm way behind. Story. Picture this, a dad, 3 kids under 12, 1 income. The pressure? Constant. Every month feels like a balancing act. School stuff, groceries, medical bills, life. He's not reckless, not living large, not buying boats or sports cars. He invests 10% into his Roth 401k, gets a 4% company match, maxes out his HSA, built a $37,000 emergency fund. That's discipline. But here's the number haunting him. $165,000 in his 401k, and every finance article he reads screams, at 40, you should have 3 times your salary saved. For him, that would be around $400,000. He's not even halfway there, and it eats at him. Because when you are the only paycheck in a house with 5 people, retirement fear hits different. The backstory. It's not like he's been making 6 figures forever. Before 2020, he didn't even clear $80,000. Then things changed, raised to $105,000, then another bump. Now he's at $130,000. His income only really took off in the last 5 years, but the internet calculators don't care about your timeline. They just show the gap. The emotional weight. And then life happened. His son needed surgeries, multiple. The HSA, which was supposed to grow, got drained. Watching that balance drop while worrying about your kid, that's not just financial stress, that's emotional exhaustion. He's relieved it's behind them now, but the savings setback still stings. The real question. He wants to retire at 65. That's 24 years away, but right now he feels like he's running a marathon, starting 5 miles behind everyone else. So he's asking, am I actually in trouble or just scared because I'm comparing myself to a perfect formula? Reality check vibe. He's not broke. He has retirement savings, an emergency fund, health coverage, growing income. But fear doesn't care about logic, especially when kids depend on you. So what do you think? Is he truly behind, or is this just what the messy middle of building wealth actually looks like for real families? Drop your take below, because a lot of quiet providers out there need to hear this. Subscribe for more powerful financial stories and press the bell icon.